Before we dive in, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided in this presentation is not a substitute for professional advice tailored to your individual situation. Always consult with a qualified and licensed professional for your specific insurance needs, and before making any financial decisions. You hear the sickening crunch of metal before you even feel the jolt. Your heart plummets into your stomach. It was a simple lane change on your way home from work, a momentary lapse in concentration, and now you're standing on the shoulder of the highway, staring at a dented bumper and a shattered taillight. Your first thought, after you realize everyone is okay, is a small sigh of relief. It's fine. I have insurance. But do you? Do you really truly know what's inside that policy you clicked purchase on 6 months ago? Do you know if you have full coverage? And more importantly, do you even know what full coverage actually means? Because I can tell you it's a phrase insurance companies love, but it doesn't mean what you think it means. If you feel a pit in your stomach just thinking about that, you are not alone. A recent J.D. Power study revealed a staggering fact. Nearly half of all drivers in the United States do not fully understand their own auto insurance policy. Let that sink in. Half. That means on any given day, tens of millions of people are driving on our roads, one small fender bender, one hailstorm, one uninsured driver away from a financial catastrophe they never saw coming. They believe they're protected by a safety net, when in reality that net is full of massive gaping holes. This video is going to change that for you. Right now, we are going to pull back the curtain on the deliberately confusing world of auto insurance. I'm going to show you step by step exactly how to find, read, and finally understand your auto insurance policy online, in plain English. No more jargon. No more confusing numbers. No more blind faith. By the end of this presentation, you will know precisely what you are paying for every month, where you are protected, and most importantly, where you might be dangerously exposed. You will go from feeling uncertain to feeling empowered. You will trade anxiety for confidence. And we're going to do it all in the next few minutes. Think about it. Your car insurance is one of the few things you are legally required to buy. Yet it's also one of the most misunderstood products on the planet. And it's not your fault. The entire industry is built on a foundation of confusing language. They throw terms at you like bodily injury liability, uninsured motorist coverage, personal injury protection, and collision deductibles, and they just expect you to nod along. It's designed to be overwhelming. It's designed to make you feel like you need a law degree just to understand what you're buying. But you don't. Let's demystify this right now. It's actually much simpler than they want you to believe. Think of your policy as a menu of different protections. The most important one is liability. Liability is just a fancy word for your fault. If you cause an accident, liability coverage pays for the other person's car repairs and their medical bills. It does absolutely nothing for you or your car. That's a critical distinction. Next, you have collision. This one is easy. Collision coverage pays to fix your car when you collide with something, whether it's another car, a pole, or a guardrail. It's for when the accident is your fault, or in some cases a hit and run. Then there's comprehensive. This is another one that sounds complicated but isn't. Think of it as acts of God and bad luck coverage. It covers your car from almost everything other than a collision. A tree branch falls on your roof? That's comprehensive. A massive hailstorm leaves dents all over your hood? Comprehensive. Your car gets stolen from your driveway? You guessed it, comprehensive. See, not so scary when someone actually explains it. Those three, liability, collision, and comprehensive, are the big three. They form the core of almost every auto policy in America. But understanding what they are is only the first step. The real danger, the place where people get into serious financial trouble, is in the numbers that come after those words. You've seen them on your insurance card, a string of numbers like 50/100/25. It looks like a secret code, but it's the key to your entire financial future. Those numbers represent the limits in thousands of dollars that your insurance company will pay out. And if the cost of an accident exceeds those limits, the rest comes directly out of your pocket. Your savings, your paycheck, your home, everything. So here is our mission today. We are going on a simple 3-step journey to make you an expert on your own policy. First, I'm going to show you exactly how to log into any major insurance company's website or app and find the single most important document they provide, your policy declarations page. This 1 or 2 page document is the Rosetta Stone of your insurance. It cuts through all the legal fluff and tells you exactly what you have. Second, we are going to dissect that page together line by line. We will translate every single coverage and every single number, so you know what 50/100/25 actually means for your bank account in a real-world accident. We'll cover what a deductible is and how choosing the wrong one can be a huge mistake. And third, I'm going to reveal the two most overlooked and criminally undervalued coverages that most people either decline or have dangerously low limits on. The ones that protect you when you get hit by someone who has no insurance or not enough insurance. This part alone could literally save you from bankruptcy. This isn't just about saving money or ticking a box. This is about protecting yourself, your family, and everything you've worked for. The peace of mind that comes from knowing you are properly protected is priceless. It's the difference between a car accident being a hassle and a car accident being a life-altering financial disaster. Are you ready to finally take control? To go from being a confused customer to a confident, informed consumer? Good. Grab your phone or pull up a chair to your computer, because the very first step is logging in and finding that all-important declarations page. Let's do it right now. Alright, first things first, pull up your insurance company's website. Whether it's Geico, Progressive, State Farm, Allstate, USAA, it doesn't matter. They all have a login or customer portal button, usually right at the top right of the page. Go ahead and click it. Now, if you're like half the population, you probably don't remember your password. Don't sweat it. Just click that Forgot Password link. They'll email or text you a reset link in seconds. This is the first tiny hurdle and you're already clearing it. Once you're in, you'll land on a dashboard. It might look a little busy with links for billing, claims, and roadside assistance. We need to cut through the noise. You are on a mission for one specific document. It's the Rosetta Stone of your auto insurance. The key that unlocks everything. It's called the Declarations page. Sometimes it's shortened to Dec page. Other times it's just listed under Policy Documents or View My Policy. Find that link. It might be a big button, or it might be tucked away in a menu. Click on Documents. Look for the most recent PDF file that says Auto Policy Declarations. Download it. Open it. This single page, maybe 2 pages, is the most important part of your entire insurance contract. The rest of the policy is a 50-page booklet of legal jargon, but this is your personalized summary. It is the legally binding truth of what you are paying for. Everything we talk about from this point forward will be found on this single document. Now let's look at it together. Don't get overwhelmed by the boxes and numbers. Simpler than it looks. We're going to dissect it piece by piece. At the very top, you'll see your name and address, and a policy number. That number is your unique identifier. If you ever need to call your insurance company or file a claim, that's the number they'll ask for. Right next to it, you'll see the policy period or effective dates. This is critical. It'll say something like January 15th, 2024 to July 15th, 2024. This is the active window for your contract. It's the 6-month or 1-year period where you are covered. Put that end date in your phone's calendar right now with a reminder set for 2 weeks before. That's your reminder to shop around or review your renewal offer. Don't let your insurance company just automatically roll you over without a second thought. That's how rates creep up. Next section. Named insured. This should be your name and maybe your spouse's. This is who the policy belongs to. Below that, you might see drivers. This is another critical checkpoint. Every single person who regularly drives your car should be listed here. Your spouse, your teenage kid who just got their license, even a roommate who uses your car to get groceries every week. If they are not listed on the policy and they get into an accident in your car, your insurance company could have grounds to deny the claim entirely. They could argue you committed fraud by not disclosing the primary drivers. This is not a maybe situation. Check that list of drivers. Is it accurate? Okay, scrolling down, you'll see the Vehicles section. It'll list the year, make and model of your car. 2022 Honda Civic. 2020 Ford F-150. Whatever you drive. But look closer. You'll see a long 17-digit number. That is the VIN, the Vehicle Identification Number. It's like your car's social security number. You need to verify this. Go out to your car, look at the little metal plate on the driver's side of the dashboard right by the windshield, or check the sticker on the inside of the driver's door. Pull out your phone and take a picture of it. Now, compare the VIN on your screen to the VIN on your car. Do they match? Exactly? I once heard from a guy named Mark. He'd bought a new car and called his agent to update his policy. A year later, he was in a fender bender, not his fault. He filed a claim. It was denied. Why? The agent had made a typo when entering the new VIN. Just one digit was off. As far as the insurance company was concerned, the car that was in the accident, Mark's actual car, wasn't the car listed on the policy. He was technically driving an uninsured vehicle. It took him weeks of stressful phone calls, emails, and escalations to get it sorted out, all because of one number he never bothered to check. Don't be Mark. Check your VIN. Now for the main event, the section that causes the most confusion: coverages. You're going to see a list of terms and a bunch of numbers next to them. It'll look like a secret code. You'll see bodily injury liability with numbers like $50,000/$100,000. You'll see property damage liability with a number like $25,000. Often they'll group this together and just write it as 50/100/25. This is the part of your insurance that pays for the other guy when an accident is your fault. That first number is the max your policy will pay for any one person's medical bills. The second number is the max it will pay for the total medical bills for everyone in the other car combined. And that third number is the max it will pay for their property damage, usually their car. Think about that for a second. If your property damage limit is $25,000 and you accidentally rear-end a brand new Tesla or a BMW, which are easily worth $50,000 or more, your insurance pays the first $25,000. And the rest? That comes from you. They can sue you for it, garnish your wages for it. It's a terrifying thought, and it all comes down to these three little numbers. We're going to do a deep dive on this specific coverage later, because it is the single most important part of your policy. Next, you might see collision and comprehensive. Next to each of these, you'll see deductible and a dollar amount like $500 or $1,000. This is the easy part. A deductible is simply the amount of money you have to pay out of your own pocket for a claim before your insurance company starts paying. Think of it like a copay at the doctor. If you have a $1,000 deductible and you cause $5,000 of damage to your own car, you pay the first $1,000, and the insurance company pays the remaining $4,000. The higher your deductible, the lower your monthly premium will be. But the more you'll have to cough up if something happens. It's a trade-off between saving money now versus saving money later. Look at your deductible. Do you have that amount of cash sitting in an emergency fund right now? If you have a $1,000 deductible but you don't have $1,000 in the bank, you've got a serious problem waiting to happen. You might be better off paying a little more each month for a lower, more manageable $500 or even $250 deductible. It's about being honest with your financial reality. Finally, at the bottom of the declarations page, you'll find the total premium. This is the bottom line price for the policy period. It should match what you're actually paying. It's often broken down per car, so you can see if that old beater in the driveway is costing you more than you think. This is your receipt. It connects all those coverages and numbers we just looked at to the real dollars and cents leaving your bank account. So take a minute. Just scan that whole document again. Does the name look right? The drivers? The cars? The VINs? Do you understand what those liability numbers are? Do you have your deductible amount saved up? This single piece of paper tells a story. It tells the story of how protected you are, or how exposed you might be. It's the difference between a car accident being a frustrating inconvenience or a life-altering financial catastrophe. And it all starts with that first line of defense, the one that protects you from the rest of the world when things go wrong. Liability coverage. Those three numbers, like 50/100/25 or 100/300/100, are not just random suggestions. They are the financial firewall standing between your life savings and a lawsuit. And the shocking truth is, the state minimum requirements in most places are so dangerously low, they're practically a trap. Choosing the wrong numbers here is the single biggest mistake you can make. And in the next part, we're going to break down exactly what those numbers mean, how much you really need, and how to increase your protection for probably less than the cost of a few cups of coffee per month. You absolutely cannot afford to miss this. Let's talk about a driver named Mark. Mark was a good guy, a safe driver. He paid his insurance premium every month on time for years. He saw on his declaration page that he had full coverage, and he figured he was set. The numbers on his policy read 25/50/25. He didn't really know what they meant, but they were the state minimum requirements, so he assumed that meant they were enough. Then came a day he'll never forget. A moment of distraction, glancing at his GPS at the wrong second on a wet road. He slid through an intersection and T-boned a brand new minivan. Inside were a husband and wife, and their 2 young kids in the back. Thankfully, miraculously, no one was critically injured, but the parents both suffered broken bones and concussions. Their minivan was totaled. This is where Mark's world fell apart. Let's break down his 25/50/25 coverage, because this is the single most important part of your policy, and it's where millions of Americans are dangerously underinsured. That first number, the 25, stands for $25,000. That's the maximum amount his insurance company would pay for any single person's medical bills in an accident he caused. The husband's initial hospital bills alone, for the ambulance, the emergency room, the x-rays, and setting his broken arm, came to over $30,000. Mark's insurance paid the first $25,000. The remaining $5,000? That was now Mark's personal responsibility. And that was just the beginning. The second number, the 50, stands for $50,000. That's the total maximum his insurance would pay for all medical bills for everyone involved in a single accident. The husband had already used up $25,000 of that. His wife's bills were another $28,000. So, $25,000 for the husband plus $28,000 for the wife is $53,000. His policy's limit was $50,000. The insurance company wrote the check for $50,000 and wished Mark the best of luck. He was now personally on the hook for the remaining $3,000, plus the $5,000 from the husband's bills. And we haven't even talked about follow-up appointments, physical therapy, or lost wages from them being out of work. That third number, the 25, stands for $25,000 in property damage. This covers the other person's car, or anything else you might hit, like a fence or a storefront. The minivan Mark hit was brand new. The value? $48,000. His insurance paid $25,000. The remaining $23,000 to replace their family vehicle? That bill landed squarely in Mark's lap. So let's do the math. Mark is now personally, legally responsible for thousands in remaining medical bills and $23,000 for the minivan. The other family's lawyer sent him a letter demanding payment for everything the insurance didn't cover, plus their pain and suffering, plus their lost income. The total was well over $100,000. Mark didn't have $100,000. The court issued a judgment against him. They garnished his wages, taking a chunk of his paycheck every single week. They put a lien on his house. His dream of retiring, of sending his own kids to college, vanished in the blink of an eye. All because he thought the state-mandated minimum was enough. The state minimum isn't designed to protect you. It's the bare minimum required by law to protect other people from you. And in today's world, with the average cost of a new car exceeding $45,000 and a single serious injury easily topping $100,000 in medical care, those minimums are a financial time bomb. So what should you have? While it depends on your personal assets, a good starting point for most people is 100/300/100. Let's translate that. $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. For people with significant assets like a home and retirement savings, many advisors recommend $250/500/100 or even higher. And here's the kicker. The thing Mark learned far too late. The cost to go from his disastrous 25/50/25 policy to a protective 100/300/100 policy? It's usually not hundreds of dollars. It's often between $10 and $30 a month. That's it. For the price of a few fancy coffees or a Netflix subscription, he could have shielded his entire financial future. He could have protected his family. He traded his life savings for the cost of a weekly latte. Don't make Mark's mistake. Log into your account right now, look at your liability limits, and if they are at the state minimum, you need to call your agent or go online and increase them today. It is the single most powerful and most affordable financial protection you can buy. But that's only half of the story. Mark's policy was about the damage he caused. What happens when someone hits you? Let's flip the script. Imagine you're the one sitting in that minivan. You did everything right. You were stopped at a light in BM. You're injured, your car is wrecked. And the driver who hit you, they have no insurance at all. Or maybe they have the same bare-bones state minimum policy that Mark had, and your medical bills are way more than their $25,000 limit. Who pays for your hospital stay? Who pays for the months of physical therapy? Who covers your lost wages when you can't work? Who replaces your car? This is where two other critically important coverages come in. Uninsured and underinsured motorist protection. They often get bundled together, and they are your lifeline in this exact scenario. Uninsured motorist, or coverage kicks in when you're hit by someone with no insurance. Instead of you having to sue a person who likely has no money to give you, your own insurance company steps in and acts as if they were the at-fault driver's insurance. They pay for your medical bills and, in some states, your lost wages and other damages, up to the limits you've selected. Underinsured motorist, or coverage is for when the at-fault driver has insurance, but it's not enough to cover your bills. Let's say your medical costs are $80,000, but the driver who hit you only has a $25,000 bodily injury limit. Their insurance pays the $25,000, and then your coverage can kick in to cover the remaining $55,000, again up to your policy limits. Here is the golden rule. Your uninsured and underinsured motorist limits should always be the same as your own liability limits. If you have 100/300 in liability to protect others, you should have 100/300 in UM/UIM coverage to protect yourself. You are essentially insuring yourself against the irresponsibility of other drivers on the road. And believe me, with an estimated 1 in 8 drivers in the US being completely uninsured, this isn't a luxury. It's a necessity. The cost for this protection is shockingly low. We're often talking about just a few dollars a month to add this fortress around your health and finances. It's the part of your policy where you are betting on yourself, and it's a bet you can't afford to lose. So now you understand the absolute core of your auto policy. Protecting your assets from a lawsuit when you're at fault, and protecting your body and your bank account when someone else is at fault and can't pay. This is the foundation. But we've left out one giant piece of the puzzle. We've covered damage to other cars and other people. We've covered damage to you from other people. But what about the single biggest asset involved in most accidents? What about your own car? What happens when you hit a patch of ice and slide into a guardrail? What happens when a tree branch falls on your hood during a storm? Or a thief smashes your window and steals your stereo? Or worse, steals the whole car? Your liability coverage does nothing. Your uninsured motorist coverage does nothing. This is where the two most famous and most frequently misunderstood types of coverage come into play: collision and comprehensive. And how you set these up can either save you a fortune or cost you thousands of dollars you didn't need to spend. Let's start with a simple image. You're driving and you hit something. Maybe it's another car, maybe it's a telephone pole, maybe it's your own garage door. Don't laugh, it happens to the best of us. The front of your car is now significantly shorter than it was a moment ago. Your liability coverage, which we just talked about, does absolutely nothing for you here. It's busy taking care of the other car, or the pole you just rearranged. To fix your own vehicle, you need collision coverage. Think of the word itself, collision. It pays for damage to your car resulting from a collision with another object, or from the car flipping over. It doesn't matter who was at fault. If you were at fault, it pays. If you were the victim of a hit and run and can't find the other driver, it pays. It is your car's personal bodyguard in any kind of crash. Now here's the catch, and it's a big one: the deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a single dime. This is the single most important number you will choose for this coverage. Let's say you have a $1,000 deductible. You get into that fender bender and the repair estimate comes back at $5,000. You are on the hook for the first $1,000. You write a check, swipe a card, hand over the cash. However you do it, that first $1,000 is your responsibility. Your insurance company then steps in and covers the remaining $4,000. If the damage was only $900, well, that's less than your deductible, so you're paying for the whole thing yourself. Your insurance company doesn't get involved. This is where you make a critical strategic decision when you buy insurance. A lower deductible, say $250, feels safe, right? A small accident won't break the bank. But to get that low deductible, you're going to pay a much higher premium every single month. On the flip side, a higher deductible, like $2,000, will dramatically lower your monthly premium. But you have to be brutally honest with yourself. If you wrecked your car tomorrow, do you have $2,000 in an emergency fund ready to go? If the answer is no, a high deductible is a dangerous gamble. This is a trade-off between your monthly budget and your emergency savings. There is no single right answer, only the answer that's right for your financial situation. Okay, so collision covers you when you hit something, but what about all the other terrible things that can happen to a car? This is where collision's partner comes in: comprehensive coverage. If collision is the bodyguard for crashes, comprehensive is the guardian angel for everything else. The official term is other than collision, which is kind of vague, so let's make it real. A hailstorm pummels your city and your car now looks like a golf ball. That's comprehensive. A thief smashes your window and steals your stereo. Comprehensive. You're driving down a country road at dusk, and a deer decides to redesign your front grille. That's comprehensive. A branch falls on your car during a windstorm. Comprehensive. Vandalism, fire, flooding, riots. All of this chaos is covered by comprehensive. It's the acts of God and random mayhem policy. And just like collision, it has a deductible. The exact same principle applies. You choose a deductible, you pay that amount first on any claim, and the insurance company covers the rest. You can even have different deductibles for each. Maybe you choose a $500 deductible for comprehensive because theft or hail seems more likely to you, but a $1,000 deductible for collision because you're a very confident driver. You have that flexibility. So now we have these two powerful coverages, collision and comprehensive, that protect the actual value of your car. This leads us to the million-dollar question, or at least the several $1,000 question: do you actually need them? Unlike liability coverage, no state in the country legally requires you to have collision or comprehensive. You can, in theory, legally drive off the lot with just the bare minimum liability. So why does almost everyone with a newer car have them? The answer isn't the government. It's the bank. If you have a loan or a lease on your vehicle, you don't technically own it yet. The bank or the finance company does, and they have a vested interest in protecting their asset, your car, until you've paid it off. Because of this, they will absolutely require you, in the terms of your loan or lease agreement, to maintain both collision and comprehensive coverage, often with the maximum allowed deductible, usually $1,000 or less. If you try to remove this coverage, you'll be in breach of your contract, and they can either force place a very expensive policy on your behalf and add it to your bill, or in some extreme cases even repossess the vehicle. But what if you're one of the lucky ones? What if you own your car outright? No loan, no lease. The title is in your name, free and clear. Now you hold all the power. You get to decide if paying for collision and comprehensive is worth it. This is where people can save hundreds, even thousands of dollars a year by making a smart decision. The decision hinges on one key concept: the actual cash value or ACV of your car. This is not what you paid for it. It's what your car is worth today with its age, mileage, and condition factored in. It's the check the insurance company would write you if your car were totaled, minus your deductible. Here's the simple math you need to do. Go to a site like Kelley Blue Book or Edmunds and get a realistic private party value for your car. Let's say your trusty 12-year-old sedan is worth about $4,000. Now log into your insurance portal and see what you're paying per year specifically for collision and comprehensive coverage. Let's say it's $600 for the year. And let's say your deductible is $1,000. Now play out the worst-case scenario: you total the car. The insurance company values it at $4,000. They subtract your $1,000 deductible. The final check they hand you is for $3,000. So ask yourself, are you willing to pay $600 this year to protect a potential $3,000 payout? That's a 20% premium. The next year, your car will be worth even less, but your premium might stay the same. A common guideline many financial experts use is the 10% rule. If your annual premium for collision and comprehensive is more than 10% of your car's value, you should seriously consider dropping the coverage. In our example, 10% of the car's $4,000 value is $400. Since you're paying $600, you're well past that threshold. At this point, you could consider becoming self-insured. You drop the coverage, you save that $600 a year, and you put it into a dedicated savings account for car repairs or a down payment on your next car. If you go 3 or 4 years without a major at-fault accident, you've saved a significant chunk of cash. This is a personal risk calculation. If your car is your lifeline and you have zero savings to replace it, you might decide to keep the coverage for peace of mind. But if you have a healthy emergency fund, paying for full coverage on an older, low-value car is often like buying a lottery ticket with a very low payout. It's a guaranteed expense to protect against a diminishing return. So right now, as you're watching this, I want you to pull up your insurance policy online. Find that section called Coverages or Your Vehicle. Look for collision. Look for comprehensive. Find 2 numbers for each: the deductible you've selected and the premium you are paying for it every 6 or 12 months. Is your deductible so low that it's secretly inflating your entire bill? Could you comfortably handle a higher one to save money every month? Or, more importantly, is your car old enough and its value low enough that you're essentially throwing money away on a policy that will barely pay out more than your deductible? Making the right call on these two coverages is the single biggest move you can make to optimize your auto insurance bill. But fixing your own car is only half the battle. You can have the best collision coverage in the world, but it does nothing for your medical bills. It does nothing for your lost wages if you can't work. And what happens when the accident isn't your fault at all? But the person who hit you either has no insurance, or the absolute state minimum garbage policy that can't even begin to cover the damage they've caused. This is where millions of responsible drivers discover a terrifying gap in their own protection, a gap that can lead to financial ruin. And we are going to find and fix that gap right now. This coverage, the one that protects you from the 1 in 8 drivers who are illegally on the road without a single penny of insurance, is called uninsured motorist coverage. And its equally important twin, the one that protects you from the tens of millions more who have insurance but not enough to cover a trip to the emergency room, is called underinsured motorist coverage. Together, they are often bundled as UM/UIM, and they are your personal financial bodyguard. They are the armor you wear because you can't trust anyone else on the road to be responsible. Let's be crystal clear about what this does. It's not about your car for a moment. This is about you, your body, your health, your ability to work and earn a living. Imagine you're sitting at a stoplight minding your own business and bam, you're rear-ended by someone texting. The impact is severe. You have a serious back injury and a concussion. The ambulance comes, you spend 2 nights in the hospital, you need an MRI, you'll need months of physical therapy, and you can't work for 6 weeks. The bills start piling up. The hospital bill alone is $80,000. Your lost wages are another $10,000. The physical therapy will be thousands more. The total cost to get you back on your feet is well over $100,000. Now, the driver who hit you gets out of his car. He's apologetic, and he tells you he doesn't have insurance. His policy lapsed. He couldn't afford it. Doesn't matter why. The fact is, he has no ability to pay for the $100,000 hole he just blew in your life. Who pays? In this scenario, your uninsured motorist bodily injury coverage pays. It steps into the shoes of the driver who hit you and pays your medical bills, your lost wages, and your pain and suffering, up to the limits you selected. It makes you whole again. Without it, you're on your own. You can sue him, sure, but you can't get blood from a stone. You're left holding a mountain of debt for an accident that wasn't your fault. Now let's change one detail in that story. The driver who hit you does have insurance. He's a responsible guy, he followed the law. The problem is, he lives in a state where the legal minimum for bodily injury liability is only $25,000 per person. His insurance company will write you a check for $25,000. And that's it. They fulfilled their legal obligation. But your bills are over $100,000. You are still $75,000 in the hole. You are still facing financial ruin. Who pays for that massive, terrifying gap? This is where your underinsured motorist coverage becomes the hero of the story. It looks at the $75,000 difference between what the other guy's insurance paid and what your bills actually are, and it covers that gap, again, up to the limits you selected. This is not a rare, 1 in a million scenario. This happens every single day in every city in America. It's the dirty secret of the auto insurance world. Millions of people are driving around legally insured, but with policies that are functionally useless in a serious accident. They are a landmine waiting for a responsible person like you to drive over. And your UM/UIM coverage is the only thing that can defuse that bomb. So let's find it on your policy right now. Pull up your declarations page online or on your app. Look for the section labeled uninsured/underinsured motorist, or simply UM/UIM. Just like your liability coverage, you're going to see 2 numbers, separated by a slash. It might say 50/100, or 100/300, or 250/500. The first number is the maximum amount your policy will pay for the injuries of any one person in your car. The second number is the maximum total amount it will pay for everyone in your car combined. So if you have 100/300 coverage and you and 2 passengers are all seriously injured by an uninsured driver, your policy will pay up to $100,000 for each of you, but no more than $300,000 for the entire accident. Now I am about to give you the single most important piece of advice in this entire guide. It is the one thing that separates a truly protected driver from a vulnerable one. Are you ready? Your uninsured and underinsured motorist coverage limits should, at an absolute minimum, be identical to your bodily injury liability limits. Let me say that again. Whatever numbers you chose to protect yourself from lawsuits when you cause an accident, you need to have those exact same numbers to protect yourself when someone else hurts you. If you have 250/500 for liability, you need 250/500 for UM/UIM. No excuses. No exceptions. Why? The logic is so simple, yet almost nobody ever thinks of it this way. When you selected your liability limits, let's say you picked $250,000, you made a conscious decision. You or your agent looked at your life, your assets, your income and said, if I cause a terrible accident and injure someone, I need $250,000 of protection to keep them from taking my house, garnishing my wages, and ruining my financial future. You decided that was the value of your financial life. That was the number required to safeguard everything you've worked for. So please explain this to me. Why would you ever give yourself less protection than you give to a total stranger? By choosing lower UM/UIM limits, you are fundamentally saying that a stranger's health is more valuable than your own. You're saying that if you injure them, they deserve $250,000, but if they injure you in the exact same way, you and your family only deserve $50,000. You are insuring the rest of the world better than you are insuring yourself and the people you love who ride in your car. It is financially illogical. It is the definition of being underinsured. You have decided what it takes to protect a life from financial ruin, and you must apply that same standard to your own. Go look at your policy right now. Do they match? If they don't, you have a critical gap in your coverage. And the best part? The cost to fix this is almost nothing. Increasing your UM/UIM coverage is one of the cheapest things you can do on your policy. To go from, say, $50,000 of protection to $250,000 might cost you $5 or $6 a month. Maybe the price of one fancy coffee. It is, without question, the single greatest bargain in all of insurance. You are buying yourself peace of mind and a shield against financial catastrophe for pennies on the dollar. There's one more piece to this puzzle: property damage. Sometimes you'll see an option for uninsured motorist property damage, or UMPD. This is designed to pay for repairs to your car if it's damaged by an uninsured driver. Now, if you have collision coverage, which we're about to discuss, UMPD can be a bit redundant because your collision coverage will also fix your car regardless of who is at fault. However, UMPD can be useful in a couple of situations. First, the deductible for UMPD is often much lower than a standard collision deductible. Maybe $250 instead of $1,000. Second, if you don't carry collision coverage on an older car, UMPD is an incredibly cheap way to get some protection against the most likely cause of a not-at-fault accident: getting hit by someone who can't pay for it. So we've plugged the dangerous gap left by irresponsible drivers on the road. You've made sure that your own health and financial future are just as protected as a stranger's. You've built a fortress around your assets. But what about the things that have nothing to do with other drivers? What about the chaos of the world itself? A freak hailstorm that turns your car into a golf ball. A deer that decides to play chicken with your front bumper at 60 miles per hour. A tree limb that falls during a storm and crushes your roof. For that, we need to talk about the two coverages most people think they understand but almost always get wrong: collision and comprehensive. And the one question you need to ask about your deductible could save you $1,000 overnight. Let's get this straight because the names are designed to be confusing. Collision and comprehensive. They sound like they cover everything, but they are incredibly specific, and misunderstanding the difference can be a nightmare. Let's start with collision. It's the simpler of the two. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, of course, but it could also be a tree, a guardrail, a light pole, or even a pothole that sends you into a ditch. If your car makes physical contact with something and gets damaged, that's what collision coverage is for. You're backing out of a tight spot at the grocery store, and you hear that gut-wrenching crunch of your bumper meeting a concrete pillar. That's a collision claim. It doesn't matter if it was your fault or someone else's. If you want to use your own insurance to fix your own car after an accident, you're using your collision coverage. Now for comprehensive. This is the one that trips everyone up. The name is the problem. Comprehensive sounds like it covers everything. Doesn't. A better name for it would be almost everything else that's not a collision coverage. It's for damage to your car from events that are, for the most part, out of your control. Think of it as the act of God and act of man coverage. We're talking about theft: someone steals your car. Vandalism: someone keys your paint job. Fire. Flooding: a massive hailstorm that makes your car look like a golf ball. a tree branch falling on your roof during a windstorm, even hitting an animal like a deer. All of those things. That's what comprehensive coverage is for. It's the stuff that happens to your car, not the stuff your car runs into. So, collision is for crashing. Comprehensive is for everything else. Seems simple enough, right? But here's where the million-dollar mistake happens. It's in the gray area. Let me give you the classic real-world example that insurance adjusters see every single day. You're driving down a country road at dusk. Suddenly, a deer bolts out in front of you. You have two choices and you have half a second to make one. Option 1, you hit the deer. It's a terrible, awful event. But as far as your insurance is concerned, it's crystal clear. Hitting an animal is a comprehensive claim. Option 2, you swerve to avoid the deer. Your reflexes are amazing. You miss it completely. But in doing so, you lose control and smash into a tree on the side of the road. Now ask yourself, which type of claim is that? You were avoiding an animal, so it should be comprehensive, right? Wrong. The moment your car hit that tree, it became a collision claim. You didn't hit the deer. You hit a tree. And that single distinction, that split-second decision to swerve, can have a massive financial impact. Why? Because of the deductible. The deductible is the most important number attached to these two coverages. It is the amount of money you have to pay out of your own pocket for a repair before your insurance company pays a single penny. If you have a $500 deductible and the repairs cost $3,000, you pay the first $500, and the insurance company pays the remaining $2,500. If the repairs only cost $400, you pay the whole thing yourself. The insurance company pays nothing. You don't even file a claim. Now, here's what you need to go check on your policy right now. Most people, and maybe you're one of them, have two different deductibles. They'll have a low deductible for comprehensive, maybe $250 or $500, and a much higher one for collision, often $1,000 or more. The logic seems sound. A cracked windshield or a run-in with a deer feels more likely than a major car crash, so you want a lower out-of-pocket cost for the more common event. But let's go back to our deer scenario. If you hit the deer, it's a comprehensive claim. With your $500 deductible, you pay $500, and insurance covers the rest of the damage. Not great, but manageable. But if you swerve and hit the tree, it's a collision claim. Suddenly, you're on the hook for your $1,000 collision deductible. Your split-second, life-saving instinct to swerve just cost you an extra $500 out of your own pocket. The insurance company doesn't care that a deer caused you to swerve. All they see is the end result. Your car collided with a tree. This is where we get to that one critical question that could save you $1,000. When you're looking at your policy online, or talking to an agent, the question isn't just, what are my deductibles? The real money-saving question is this: how much would my monthly premium change if I made my collision and comprehensive deductibles the same? Let's say you have that common setup: a $500 comprehensive deductible and a $1,000 collision deductible. You're probably paying a higher premium for that lower comprehensive deductible. Ask for a quote to change your comprehensive deductible to match your collision at $1,000. Or alternatively, see how much it would cost to lower your collision deductible to $500 to match your comprehensive. You might be shocked by the numbers. Sometimes, raising your comprehensive deductible from $500 to $1,000 might only save you a few dollars a month. In that case, it's probably not worth the extra risk. But often, especially if you have a very low comprehensive deductible like $100 or $250, raising it to $500 or $1,000 can result in significant savings on your premium. You might save $20, $30, even $40 a month. Let's be conservative and say you save $25 a month by raising that deductible. That's $300 a year. In 3 years, that's $900 you've saved just by making one simple change. You've essentially paid for your own higher deductible with the money you saved on the premium. This is about playing the odds intelligently. You are betting on yourself. Are you willing to risk an extra $500 out of pocket for a rare comprehensive event in exchange for guaranteed cash savings in your bank account every single month? For many people, the math on that makes a lot of sense. You are taking control of your finances instead of just accepting the default numbers the insurance company gives you. That's the $1,000 move. It's not just about the potential out-of-pocket cost in one accident. It's about the guaranteed savings over the life of your policy. So, your action item is simple. Log in to your insurance portal, find your coverages, look for collision deductible and comprehensive deductible. See what they are. Then use the online quote tool or call your agent and ask that one simple question. What happens to my premium if I make them the same? The answer could start saving you money tonight. Now you understand how to protect your own car from nearly any physical damage imaginable. You know the secret language of collision and comprehensive, and you know how to strategically use your deductible to save yourself a fortune. You've plugged a major hole in your financial boat, but we've only been talking about fixing your car. What happens when that pole you hit wasn't just a pole? What if it was holding up the awning of a downtown storefront, and the whole thing came crashing down, shattering a plate glass window? Or worse, what if it wasn't a pole or a deer you hit? What if it was a person? The numbers we're about to discuss aren't in the hundreds or thousands of dollars. We're now talking about tens of thousands, hundreds of thousands, even millions. This is where your financial life is truly on the line. And the two lines on your policy that are supposed to protect you from total financial ruin are almost certainly way too low. These two lines are called bodily injury liability and property damage liability. Together, they make up your liability coverage. This isn't the coverage that fixes your car or pays your medical bills. This is the coverage that pays for the damage you cause to other people and their property. This is the coverage that stands between you and a lawsuit that could take everything you own and everything you will ever own. Let's start with bodily injury, or BI. This pays for the medical expenses, lost wages, and pain and suffering of anyone you injure in an accident where you are at fault. Now, most people hear medical expenses, and they think of a doctor's visit or a broken arm. That is a dangerously naive way to think about it. I want you to imagine a scenario. It's a Tuesday afternoon. You're driving home from work. Maybe you're a little tired. You glance down at your phone for just 2 seconds to read a text. But in those 2 seconds, the car in front of you slammed on its brakes. You don't have time to react. You rear-end them hard. It's not just a fender bender. The car you hit was a minivan. Inside was a mother and her 2 young children. The impact causes a chain reaction. The mother suffers severe whiplash and a concussion. One child has a broken leg. The other, in the back, sustains a serious spinal cord injury. The ambulance arrives. The flashing lights, the sirens, the chaos. This is the moment your life changes. Let's tally up the cost of this 2-second mistake. Ambulance ride for 3 people. That's a few $1,000s right there. Emergency room visit for 3 people. Another $10,000 easily. The mother needs MRIs and ongoing neurological care for her concussion. The first child needs surgery to set their leg, plus months of physical therapy. The second child's spinal injury requires emergency surgery, a lengthy stay in the ICU, and potentially a lifetime of specialized care, wheelchairs, and home modifications. We are no longer talking about thousands of dollars. We are talking about hundreds of thousands, potentially millions of dollars in medical bills over a lifetime. Plus, the mother can't work for months because of her injuries. That's lost income you're responsible for. Then there's the non-economic damage, the pain and suffering, which a court can assign a massive dollar value to. Now, pull out your insurance declarations page. Look at your bodily injury liability limits. They are probably written as 2 numbers like 25/50th. Do you know what that means? It means your insurance company will pay a maximum of $25,000 for any single person's injuries, and a maximum of $50,000 total for the entire accident, no matter how many people are hurt. Let that sink in. In our scenario, with 3 injured people and medical bills soaring into the 6 or 7 figures, your policy offers a pathetic $50,000. It's like trying to put out a raging forest fire with a squirt gun. Your insurance company will write a check for $50,000, and then they will wish you the best of luck. Because the family's lawyer isn't going to just walk away. They are going to come after you personally for the rest. For the other $950,000, they will sue you, and they will win. A court will issue a judgment against you, and that judgment gives them the right to seize your assets. Your savings account? Gone. Your retirement fund? Gone. The equity in your home? They can force a sale. And it doesn't stop there. They can garnish your future wages. That means for the next 10, 20, maybe 30 years, a portion of every single paycheck you earn will be taken from you and sent to that family to pay for the damage you caused. You will be working for them. That 2-second glance at your phone just handed you a life sentence of financial servitude. That is what happens when your bodily injury limits are too low. But that's only half of the nightmare. Remember the second line? Property damage liability, or PD. This covers the damage you do to other people's stuff. Most people think this just means the other person's car. And they think, "Oh, a $10,000 or $20,000 limit should be fine." That's another catastrophic mistake. First, let's talk about cars. The average price of a new car in the United States is now over $48,000. You tap the bumper of a brand new Ford F-150 or a Toyota Highlander, and you've easily caused $15,000 in damage with modern sensors, cameras, and crumple zones. What if you hit something more expensive? A new Tesla Model Y? A BMW? A Mercedes? You could total a $70,000 vehicle in an instant. What if you cause a multi-car pileup? You're now on the hook for repairing or replacing 3, 4, 5 different vehicles. Many state minimum property damage limits are as low as $10,000 or $25,000. You can exceed that by hitting a single moderately priced SUV. And just like with bodily injury, once your insurance pays out its limit, you are personally on the hook for the rest. So you total someone's $60,000 truck, and you have a $25,000 policy. Congratulations, you now have a $35,000 bill that you have to pay out of pocket. But property damage isn't just about cars. What if you swerve to avoid a deer, lose control, and plow through someone's expensive custom-built brick fence and landscaping? That could be a $30,000 repair bill. What if you slide on ice and take out a traffic light pole or a major utility box? You're not just paying for the pole. You're paying for the specialized crew to come out and fix it, often at emergency rates. That can be tens of thousands of dollars. What if you crash into a building? A storefront? The damage can easily climb into the six figures. Your $25,000 policy is a joke in these situations. So let's go back to our original tragic scenario. You rear-ended that minivan. Not only did you cause catastrophic injuries, which your bodily injury coverage won't even begin to cover, but you also totaled their brand new $55,000 minivan. Your property damage limit is $25,000. So after your insurance pays that, you still owe them $30,000 for their vehicle on top of the hundreds of thousands, if not millions, you owe them for their medical bills and suffering. This is the one-two punch that destroys people's lives. It's a financial knockout. And the crazy part is millions of Americans are driving around with these ticking time bomb policies and they have no idea. They think because they have an insurance card in their wallet, they're covered. They're not covered. They are one mistake away from total and complete financial ruin. So why are these limits so low? Because it's cheap. Insurance companies advertise the lowest possible price to get you in the door, and that price is for the state-mandated minimum coverage. You, the consumer, just want to be legal and save a few bucks, so you take it, not understanding you've just bought a lottery ticket to bankruptcy. So what should you do? Right now, this is the most important financial advice you will hear all year. You need to go to your online portal or call your agent and raise your liability limits. Do not accept the state minimums. They are a trap. For bodily injury, you should have, at the absolute minimum, $100/300. That's $100,000 per person and $300,000 per accident. Even better, and what I personally recommend, is $250 to $500. For property damage, you need at least $100,000. This is non-negotiable in a world of $50,000 trucks and Teslas on every corner. Now I know what you're thinking. That sounds expensive. Raising my limits that much is going to double my premium. And here is the secret that the insurance industry doesn't shout from the rooftops. It's shockingly cheap to increase your liability coverage. The biggest part of your premium is the base cost of having a policy at all. Increasing your liability from the pathetic state minimum of $25/50/25 to a truly protective level of $100/300/100 might only cost you an extra $15, $20, or maybe $25 a month. That's it. For the price of a few cups of coffee or a single streaming service subscription, you are buying a fortress of protection that can prevent you from losing your house, your savings, and your future. There is no better return on investment for your financial safety on the planet. You've just built a financial wall to protect everyone else from a mistake you might make. You're now a responsible driver with a policy that can actually cover the real-world cost of a serious accident. But in doing so, we've exposed a terrifying new problem. What happens when the person who hits you is one of the millions of drivers who didn't watch this video? What happens when they're the one with that worthless state minimum policy? Or even worse, what if they have no insurance at all? Who pays for your totaled car? Who pays for your medical bills when you're the one in the ambulance? The answer is going to shock you, and it's exactly what we're going to break down next. The answer is, in most cases, you do. You pay. Your insurance pays. But only if you have two of the most misunderstood, yet critically important coverages on your entire policy. These coverages are your financial bodyguards, your last line of defense against the carelessness of others. They are called uninsured and underinsured motorist coverage. Let's call them UM and UIM for short. And understanding what they do is the difference between a terrible accident being a manageable crisis or a life-altering financial catastrophe. First, let's tackle the ghost on the highway, the uninsured driver. Imagine this scene. You're driving home from work, listening to your favorite podcast, stopped at a red light. Suddenly, bam, a bone-jarring impact from behind. You're thrown forward, your head hits the steering wheel, and your brand new car is now a crumpled mess. The other driver is apologetic, but when the police arrive, the truth comes out. He let his insurance lapse 2 months ago. He has zero coverage. He also has no job and no assets to his name. You can sue him, sure, but as the old saying goes, you can't get blood from a stone. So who pays for the tens of thousands of dollars in damage to your car? Who pays for your ambulance ride, your hospital stay, your physical therapy, and the wages you lose from being unable to work for 6 weeks? Without uninsured motorist coverage, the answer is you. It all comes out of your pocket. Your life savings could be wiped out by one person's irresponsible decision. This is where uninsured motorist coverage steps in and becomes the hero of the story. It's insurance you buy for yourself to protect you from people who don't have insurance. It essentially stands in the place of the insurance the other driver should have had. Typically comes in 2 parts. First, there's uninsured motorist bodily injury, or UMBI. This is the big one. This pays for your medical expenses, your passengers' medical expenses, lost wages, and even for pain and suffering if you're injured by an uninsured driver. In a country where a single trip to the emergency room can cost thousands and a major injury can lead to hundreds of thousands in bills, UMBI isn't a luxury, it's a lifeline. It prevents a car accident from turning into personal bankruptcy. Second, there's uninsured motorist property damage, or UMPD. This, as the name implies, pays to repair or replace your car if it's damaged by an uninsured driver. Now you might be thinking, wait, doesn't collision coverage do that? And you're right, it does. But UMPD can have a much lower deductible than your collision coverage, sometimes as low as a couple $100s. In some states, if you don't carry collision coverage to save money, UMPD is your only protection against your car being totaled by someone with no insurance. Now let's talk about the second, more subtle danger, the underinsured driver. This person is arguably more common and, in some ways, more insidious. They followed the law. They have insurance. The problem is, they only have the bare minimum amount required by their state. And state minimums are terrifyingly low. In some states, the minimum property damage liability is just $5,000. $5,000. The average price of a new car in America is nearly $50,000. What do you think a $5,000 policy is going to do when that driver totals your new SUV? Let's paint a picture. You're in a serious accident that wasn't your fault. Your medical bills climb to $100,000. You discover the driver who hit you has a state minimum bodily injury policy of just $25,000. Their insurance company will write a check for $25,000, and that's it. They fulfilled their legal obligation. You are still on the hook for the remaining $75,000. Your health insurance might cover some of it, but you'll still face huge deductibles, copays, and out-of-network charges. Not to mention, it won't cover your lost income. You're left holding the bag for a massive financial shortfall, unless you have underinsured motorist coverage. UIM is designed for this exact scenario. It bridges the gap. It kicks in after the other driver's insurance maxes out, covering the remaining costs up to the limit you selected on your own policy. If you have $100,000 in UIM coverage, it would step in to pay that remaining $75,000 of medical bills and lost wages. It makes you whole. Just like its uninsured counterpart, it comes in 2 flavors: underinsured motorist bodily injury, UIMBI, and underinsured motorist property damage, UIMPD. They work the exact same way, covering the gap for your medical bills and your car repairs, respectively. So right now, I want you to pull up your policy declaration page online. Let's find these coverages. Scan down the list past the liability section we talked about before. You are looking for line items that say uninsured motorist bodily injury and underinsured motorist bodily injury, or abbreviations like UMBI and UIMBI. You'll also see the property damage versions, UMPD and UIMPD. Next to them, you'll see your coverage limits. Just like liability, they're often shown as split limits like 50/100. This would mean your policy would pay up to $50,000 for one person's injuries and a maximum of $100,000 for everyone injured in your car combined. The crucial question is, are those numbers high enough? Here is the single most important piece of advice I can give you about this. Your uninsured and underinsured motorist limits should, at the absolute minimum, be equal to your own bodily injury liability limits. Think about the logic here. Your liability limits represent the amount of protection you think you need to protect your assets if you hurt someone else. If you've decided you need $100,000 of liability coverage to protect your savings and your home from a lawsuit, why on earth would you give yourself and your family less protection than that? You are valuing a stranger's health and financial well-being more than your own. You are saying that if an uninsured driver puts you in the hospital, you're okay with having less coverage than if the roles were reversed. It makes no sense. Protect yourself as well as you protect others. Match your limits. And the best part? This coverage is shockingly cheap. We're often talking about just a few extra dollars a month to increase this protection from a paltry state minimum to a robust six-figure safety net. It is the single best bargain in all of auto insurance. If you're still not convinced, consider this. The Insurance Research Council estimates that 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means if you're sitting at a stoplight with 7 other cars around you, there is a statistically significant chance that one of them has absolutely no insurance. That's a game of Russian roulette you're playing every single day. You get behind the wheel. You cannot control their choices. You cannot force them to be responsible. But you can and you must control how protected you are from those choices. Checking your UM and UIM coverage right now isn't just a smart financial move. It's a profound act of self-preservation. So we've covered how your insurance protects your assets from others, and how it protects you from others. But we've left out one massive piece of the puzzle: your car itself. We've talked about what happens when another person hits you. But what happens when the accident is your fault? Or when there's no other driver involved at all? A tree falls on your car during a storm. A deer jumps out on a dark country road. Your car is stolen from your own driveway. Or a rogue shopping cart rolls across the parking lot and leaves a giant dent in your door. Does your insurance cover any of that? Or are you left with nothing but a car payment on a vehicle that no longer exists? The difference between financial ruin and a minor inconvenience comes down to 2 words we'll demystify next: collision and comprehensive. These are the 2 coverages that actually protect the hunk of metal, glass, and plastic you drive every single day. While liability coverage protects you from lawsuits, collision and comprehensive protect your investment. They are the shield between your car and the chaotic, unpredictable world. Let's start with collision. The name says it all. This coverage pays to repair or replace your vehicle if it's damaged in a collision with another object, or if it overturns. Think about it. You're backing out of a tight spot at the grocery store, and you misjudge the distance to a concrete pillar. Crunch! That's a collision. You're driving on a slick, rainy road, you lose traction on a curve and slide into a guardrail. That's a collision. You're in a fender bender at a stoplight, and the other driver is 100% at fault, but you find out they have 0 insurance. Guess what? Your collision coverage can step in to fix your car, so you're not left chasing down an uninsured driver in court for months. This is a critical point many people miss. Collision coverage pays out regardless of who is at fault. Whether you caused the accident, another driver caused it, or it was a solo incident like hitting a pothole that blows out your tire and bends your rim. If your car is damaged from a physical impact while it's in motion, this is the coverage that saves you. Now, it's not a blank check. There's a key component called the deductible. The deductible is the amount of money you have to pay out of your own pocket for a claim before your insurance company pays a single dime. You choose this amount when you buy your policy. A common deductible is $500, but it could be $250, $1,000, or even more. Let's say you have a $500 deductible, and you get into an accident that causes $8,000 in damage to your car. You pay the first $500 to the repair shop, and your insurance company covers the remaining $7,500. The trade-off is simple. A higher deductible means you're taking on more risk yourself, so your monthly premium will be lower. A lower deductible means the insurance company takes on more risk, so your premium will be higher. When you check your policy online, finding your collision coverage is step 1. Finding your deductible is step 2. It tells you exactly how much skin you have in the game. So, if collision covers you when your car hits something, what about everything else? What about the deer that jumps out of the woods at dusk? What about the hailstorm that turns your brand new hood into a dimpled mess? What about the thief who smashes your window and steals your stereo, or worse, steals the entire car? What about the tree branch that snaps in a windstorm and lands squarely on your roof? None of those are technically a collision. You didn't run into them. So are you just out of luck? This is where the second hero of our story comes in. Comprehensive coverage. It's sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from basically anything that isn't a collision or an overturn. It's the acts of God and acts of chaos policy. Fire, theft, vandalism, falling objects, floods, earthquakes, riots, and yes, hitting an animal, all of that falls under the comprehensive umbrella. Think of it this way: collision is for when your car hits an object. Comprehensive is for when an object hits your car, or when it's damaged by a non-driving event. A baseball through your windshield? Comprehensive. Your car is stolen from your driveway? Comprehensive. A flood sweeps through your neighborhood? Comprehensive. Just like collision, your comprehensive coverage has its own deductible, which you also have to pay before the insurance kicks in. You can often set different deductibles for each. For instance, you might have a $500 deductible for collision, but a lower $250 deductible for comprehensive because things like a cracked windshield are far more common. So let's put this into a real-world scenario. You're driving at night and a deer runs onto the road. Scenario: you swerve to miss the deer, lose control, and hit a tree. Because you collided with the tree, that claim goes under your collision coverage. Scenario B: you don't have time to swerve and you hit the deer. In the eyes of almost every insurance company, hitting an animal is not considered a collision. It's a random, unpredictable event. That claim goes under your comprehensive coverage. Same road, same deer, totally different outcomes for your insurance. Understanding this distinction is what separates a savvy consumer from someone who is just guessing. Now let's get practical. How do you find this on your policy? Log into your insurer's website or open their app. Navigate to the section for your policy documents and pull up your Auto Insurance Declarations page. This is your policy's Rosetta Stone. Under the section listing your vehicle, you'll see a list of coverages. Scan down that list. You are looking for two specific lines: collision and comprehensive. Next to each one, you will see the critical information. It will either list your deductible, for example, collision $500 deductible and comprehensive $250 deductible, or it will say something like declined or not included. If you see a deductible amount, you have the coverage. If you don't see the line item at all, or it says you declined it, you are driving without that protection. Your vehicle itself is not insured against damage or theft. This brings us to the ultimate question: do you actually need them? If you have a loan or a lease on your car, the answer is not up to you. Your lender requires you to carry both collision and comprehensive to protect their financial interest in the vehicle until it's paid off. But if you own your car free and clear, the choice is yours, and it becomes a calculated financial decision. The first step is to know your car's actual cash value, or ACV. This isn't what you paid for it. It's what it's worth today, considering its age, mileage, and condition. You can get a rough estimate from sites like Kelley Blue Book or Edmunds. This ACV is the maximum amount an insurance company will pay you if your car is totaled, minus your deductible. Here's a common rule of thumb some people use. If the annual cost for your collision and comprehensive premium is 10% or more of your car's actual cash value, you might consider dropping them. Let's say your 10-year-old car is worth $5,000. You check your policy and see that you're paying $600 a year just for the collision and comprehensive portion of your premium. That's 12% of the car's value. If you totaled it after your $500 deductible, you'd get a check for $4,500. Is it worth paying $600 a year to protect that potential $4,500 payout? For some, the math says no. They'd rather self-insure by saving that $600 a year in an emergency fund. But there's a much more important, more personal question you have to ask yourself, and it trumps any rule of thumb. If your car were destroyed in an accident tomorrow, could you afford to repair it or buy another one without going into debt or facing a major financial hardship? If you have $10,000 in your emergency fund and your car is only worth $4,000, then dropping the coverage might make sense. But if you have little to no savings and that car is your only way to get to work and earn a living, then paying for collision and comprehensive, even on an older car, isn't just about protecting the car's value. It's about protecting your entire financial stability. It's your personal safety net, ensuring that one bad day on the road doesn't send your life spiraling. So you've checked your liability, your medical payments, and now you know exactly where you stand with collision and comprehensive. You've audited your entire policy. You feel protected. But there's one final, hidden layer of coverage that most people don't even know they have, or worse, don't know they need. It costs just a few dollars a month, but it can save you from being stranded, helpless on the side of a highway at 2 a.m. We'll uncover that final piece of the puzzle next. That final piece of the puzzle, the one coverage that acts as your personal guardian angel on the asphalt, is roadside assistance. I know. It doesn't sound as dramatic as liability, or as important as collision. Many people dismiss it as an unnecessary upsell, a frill. They think, I have a new car, it won't break down. Or I know how to change a tire. But that's like saying you don't need a fire extinguisher because you're a careful cook. Completely misses the point. Roadside assistance isn't just about fixing a problem. It's about what happens to you, physically and emotionally, in the minutes and hours after that problem occurs. Let's paint a picture. It's late. You're driving home through an unfamiliar area after a long day. Suddenly, you hear that sickening thwump 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 of a flat tire. You pull over to the shoulder, cars and trucks screaming past you just a few feet away, shaking your entire vehicle. It's dark. It's starting to rain. Maybe your phone is dying. The spare tire is buried under a week's worth of groceries and gym equipment in your trunk. Even if you get to it, are you really prepared to wrestle with a rusty lug wrench on a sloped, muddy shoulder while traffic whizzes by? This is the moment where a few dollars a month transforms from a line item on your bill into one of the best investments you've ever made. Instead of panicking, you make one phone call. You open your insurer's app and tap a button. And in that moment, you've outsourced the stress. You know that a professional is on their way. Help is coming. That feeling of security in that moment of vulnerability is worth 100 times what you pay for it. So when you're logged into your online portal, look for roadside assistance, towing and labor, or emergency road service. Here's what it typically covers. First and most obviously is towing. But here's the critical detail you need to check. The distance. A basic plan might only tow you to the nearest qualified repair shop, or for a maximum of 15 miles. A premium plan might cover you for up to 100 miles, or to the shop of your choice within that radius. This is a huge difference. If your trusted mechanic is 25 miles away, that basic plan is going to leave you with a hefty bill for the extra mileage. Second is battery jumpstart service. Dead batteries are one of the most common vehicle issues, and they rarely happen at a convenient time. Instead of trying to flag down a stranger and hoping they have jumper cables and know how to use them without frying your car's computer, a professional shows up and gets you running in minutes. Third, flat tire service. If you have a functional spare tire, they will come and do the dirty work for you. They'll change the tire right there on the spot. No kneeling in the mud. No fighting with a jack on uneven ground. Fourth, fuel delivery. We've all been there, pushing our luck with the gas light on. If you run out of gas, they'll bring you a couple of gallons, usually enough to get you to the next station. You might have to pay for the gas itself, but the delivery service is covered. And fifth, lockout service. You step out of the car for just a second to grab something, the door closes, and you hear that dreaded click. Your keys are sitting on the driver's seat. Instead of paying a locksmith $150 for 30 seconds of work, your roadside assistance has you covered. The cost for this incredible peace of mind? Often it's as little as $2 to $5 a month. Think about that. For the price of one fancy coffee, you get a full year of knowing you'll never be truly stranded. A single tow in a major city can easily cost over $200. A single locksmith call can be just as much. You use this service just once every 5 or 10 years, and you've more than gotten your money's worth. It is, without a doubt, the single best value in auto insurance. So we've done it. We've gone on a complete journey through the maze of your auto insurance policy. We started with a simple goal: to log in and understand what you're actually paying for. And now you're armed with the knowledge to not just understand it, but to take control of it. Let's bring it all home. Let's create your 5-minute insurance checkup plan. This is the summary of everything we've learned, the action plan you can use right now and every 6 months from now on. Step 1. Log into your insurer's website and pull up your policy's declarations page. This is your map, your cheat sheet. Everything you need is on this one document. Step 2. Immediately find your liability limits. Look for those 3 numbers. Are they at the state minimum? If so, you know you're playing with fire. Your goal should be to get as close to 100/300/100 as you can comfortably afford. This is your shield against a lawsuit that could wipe you out financially. Step 3. Look at your collision and comprehensive deductibles. Ask yourself one honest question. If I had to, could I write a check for this amount tomorrow without causing a financial crisis? If the answer is no, you need to lower your deductible. If the answer is a confident yes, you might be able to raise it and save some money on your premium. Step 4. Check your uninsured and underinsured motorist coverage. Remember, this isn't for them. It's for you. It protects you and your family when you're hit by someone with little or no insurance. Your goal is to have these limits match your own liability limits. You are just as important to protect as the person you might hit. Step 5. Scan for the high-value, low-cost add-ons. Do you have rental reimbursement? If you rely on your car to get to work, it's a must-have. And do you have roadside assistance? If not, add it. It's the cheapest peace of mind you can buy. That's it. 5 steps. In less time than it takes to wait for a coffee, you can go from being an uninformed consumer to a savvy, protected driver who is in complete command of their financial security. You are now in control. You are no longer just blindly paying a bill every month, hoping for the best. You understand the levers you can pull, the choices you can make, and the profound impact those choices have on your life. This isn't just about car insurance anymore. It's about a fundamental shift in how you approach your finances. It's about moving from a place of anxiety and confusion to a place of confidence and power. So here is my challenge to you. Not tomorrow, not next week. Right now. When this video ends, don't just click away to the next thing. Open a new tab in your browser, go to your insurance company's website, and log in. Pull up that declarations page. Take 5 minutes and walk through those steps we just outlined. And then I want you to do one more thing. Come back here and leave a comment. Tell us one thing you learned or one change you made because of this video. Did you realize your liability was dangerously low? Did you add roadside assistance? Did you finally understand what a deductible really means? Your comment won't just be a comment. It will be proof that you took action. And it might just be the push that someone else reading it needs to do the same, potentially saving them from a financial catastrophe down the road. You've just invested this time in yourself, in your financial education, and that is one of the most powerful investments you can ever make. It pays dividends for the rest of your life. If this journey gave you even one moment of clarity, one aha moment that made you feel more in control, please do me a small favor and hit that like button. It's a simple click for you, but it tells the YouTube algorithm that this is important information that more people deserve to see. And if you want to continue this journey of taking control of your money and building a more secure future, make sure you subscribe and turn on notifications. We are just getting started on demystifying the complex world of personal finance, one simple, actionable step at a time. Thank you for watching. Now go be the boss of your insurance.